I spent a large part of the century watching intelligent people do foolish things with money. This is not mockery, but diagnosis. Humanity's relationship with money is sometimes as passionate as a love story, sometimes as inevitable as a tragedy, but it is almost always irrational. This story begins in the late 1920s, in the heart of New York, on Wall Street. The atmosphere was blue, the streets were crowded, and everyone was caught up in the same belief. Stocks could only go up. America was young, hopeful, and productive back then. Every day, a new factory opened, a new rich person was born. Radio broadcasts, magazines, banks, they all sang the same tune. The stock market is the gold mine of the future. And people got caught up in the rhythm of this melody. A shopkeeper would sell his milk in the morning and buy stocks in the evening. A teacher would borrow money and invest his retirement funds in the stock market. Taxi drivers told their passengers which stocks would rise in value. Everyone was an investor, but no one knew what investing was. Then came 1929. One Friday morning, stock prices began to fall. On Saturday, they fell further. On Monday, panic set in. On Tuesday, people rushed to the banks. And on Wednesday morning, dreams evaporated. The stock market didn't crash. A belief crashed. People believed the market had only one direction, up. But the market was a mirror of human nature, unstable, emotional, ruthless. That day, millions of people lost everything. But one person won, not with money, but with awareness. That person's name was Benjamin Graham. He was a brilliant economist in his 20s. He worked as a young analyst on Wall Street. He loved mathematics. He loved logic. But most of all, he loved to spot the absurd. As the stock market rose, Graham noticed something. No one was asking why. No one was thinking, what is this company's real value? Everyone was asking, will it go up even more tomorrow? Graham lost his fortune in the 1929 crash, but he didn't lose his mind. He learned a lesson from that disaster. Investors don't lose money. They lose it by trusting the wrong place. And from that moment on, he had a mission: to take investing off the gambling table and turn it into a science and knowledge. In 1934, Graham wrote a book with his student David Dodd. The book was called Security Analysis. This book is still considered the Bible of the financial world today. But back then, only a handful of people understood how important it was. The book began with this sentence: investment activity is an activity in which fundamental principles are secured and satisfactory returns are achieved based on comprehensive analysis. Activities that do not meet these requirements are speculative. It may seem simple, but every word was revolutionary. Graham was telling the world, investing begins with thought, not with guesses or probabilities. What is investing, really? Today, everyone uses this word, but very few understand its meaning. According to Graham, investing is not a probability, it is a judgment. You buy a stock because you have analyzed it. You know its numbers, its debt, its income, its management, its risks. And with that knowledge, you say, yes, it's worth it. But if you buy it, just because the price will go up, it's no longer an investment, it's gambling. Graham sums it up this way: the investor is concerned with value, not price. In other words, the market price is merely an expression of opinion, but value is reality. And finding that reality requires patience and intelligence. Graham says, every investor has a little speculator in him, and every speculator has a little investor in him. The difference is which side is dominant. The investor is patient. He knows he is a partner in a company. For him, a share is not a piece of paper, but an asset. The speculator, on the other hand, is impatient. For him, the market is a playground. One day he wins, the next day he loses, but he's always on the move. Graham explains this difference as follows. The investor sees time as a friend. The speculator sees time as an enemy, because the investor knows that value emerges over time, but the speculator wants the price to move immediately. Analyze, don't believe. The word Graham repeats most often is analysis. In his eyes, analysis is a ritual. When you look at a stock, a company, or a bond, you read not only the numbers, but also the story. Why does that company exist? What does it produce? Is its profit sustainable? Is its management honest? Are its debts balanced with its assets? If the answers to these questions are unclear, it's not an investment, it's uncertainty. And uncertainty is the most expensive commodity in the market. According to Graham, the first rule of investing is don't lose, and the second rule, don't forget the first rule. This is not just a joke, it is a principle. When Graham said, preserve your principle, he was actually defining a mindset. Therefore, the primary goal of investing should be to protect your capital. Profit comes second. Most people do the opposite. They think about winning first, then not losing. But according to Graham, everyone who acts in reverse order arrives at the same conclusion: loss. One of Graham's deepest observations was this: markets don't change. Because people don't change, human nature includes fear, greed, haste, regret, and hope. These emotions determine prices. But value is emotionless. Therefore, Graham did not just provide investors with information about finance and the market. He also taught them to know themselves. An investor should understand the fluctuations within themselves before the fluctuations in the market. Panic, greed, and haste were the enemies, and most investors lost not because of the external market, but because they succumbed to the panic within themselves. Speculators always want to win, more every day, every week, every year. But, Graham says, a speculator loses a piece of his peace of mind for every dollar he earns, because the market tests the human mind. Short-term gains turn into long-term addiction. A stock rises, dopamine is released. A stock falls, fear sets in. Then it rises again. Hope returns. And this cycle is like a lab rat pulling the same lever, waiting for the lot to turn on. For the speculator, the market is a gambling table. For the investor, it is a business partnership. That is the difference. Graham was actually like a philosopher. Finance was merely a tool for him. His real goal was to prove the supremacy of logic. He said, "Logic is the market's only lasting advantage." No matter how smart an investor is, if they can't control their emotions, they lose their mind. But no matter how simply an investor thinks, if they are patient, they will win. Graham won not with complex formulas, but with simple principles, because he knew this. In finance, complexity often hides ignorance. And finally, Graham summarized the definition of investing in a single sentence. Investing is a business that can be justified both qualitatively and quantitatively. So it must be numerically logical and also make sense. If you rely solely on your emotions, that's not a justification, it's gambling. But if you've analyzed, assessed the risks, and calculated the value, that's investing. Graham pulled back the curtain on Wall Street, and he showed us this truth. Investing is a test of character, not intelligence. While the ashes of 1929 were still warm, Benjamin Graham quietly continued his work. Many believed the market was dead, but Graham knew only one thing was dead: innocence. It was now an undeniable truth that investment must be disciplined analysis, not blind hope. But there was still a problem. People hadn't learned their lesson. As soon as the stock market recovered, the same story began again. This time in a different era, with different technologies, different hopes, but essentially with the same feeling, the fear of missing out. Graham created a concept to break this cycle: margin of safety. This was the simplest but deepest principle of investing. When investing, leave room for error, because mistakes are inevitable. Think of a bridge. Thousands of vehicles will cross this bridge. Does the engineer build the bridge to carry only 10 tons? Number. He builds it to carry 30 tons. Because in real life, the wind blows, the load increases, mistakes happen. Graham says, investing is like building a bridge. It must remain solid not only under the weight you calculated, but also in unexpected situations. That's why investors always look for the difference between price and value. If a stock is worth $100, but you buy it for $60, the $40 difference is your margin of safety. This difference protects you. Even if you're wrong, you won't go completely under. But if you buy at or above its true value and the market sneezes, you catch pneumonia. Graham says that an investor's greatest enemy is not the market, but themselves, because people make mistakes. And when you make a mistake, the only thing that protects you is the margin of safety. Graham writes, analyses can be wrong. Predictions can be wrong. But the margin of safety can tolerate being wrong. This is not just a financial principle. It is also a philosophy of life. Even when forming a friendship, a business, or a relationship, leave yourself a margin for possible disappointments, possible changes, possible people. Because the world is built on uncertainty, not perfection. Graham's most striking metaphor is a fictional character he calls Mr. Market. Imagine a business partner knocking on your door every morning. His name, Mr. Market. Every day he tells you the same thing. Today, I want to buy your shares at this price or sell my shares at this price. But Mr. Market has a problem. He is unstable. One day he is cheerful and raises prices very high. The next day, he is depressed and wants to sell everything for next to nothing. What is your job? Not to keep up with him, to take advantage of his craziness. Graham says, the intelligent investor does not dance to Mr. Market's tune. He uses Mr. Market's volatility to his advantage. So, if the market is falling, it's not your enemy, it's your opportunity. Because the price has deviated from the value, and the investor profits from the difference between price and value. Mr. Market lives not only on Wall Street but everywhere, in real estate prices, cryptocurrencies, gold purchases. People always behave the same way. They want to buy more when prices rise, and they flee when they fall. But Graham's students know this. When something is popular, it is usually expensive. When something is feared, it is usually cheap. This paradox is the basis of investing. But because everyone is a slave to their emotions, they cannot see these opportunities. That's why Graham teaches investors not just a formula, but mental discipline. Understanding the market is actually understanding people. And then one day, a quiet boy from Nebraska becomes Graham's student. His name, Warren Buffett. When Buffett attended Graham's classes at Columbia University in the 1950s, he memorized every word. But he didn't just memorize them, he lived them. Graham's philosophy became not just an investment method for him, but a way of life. So much so that Buffett later said, I am 85% Benjamin Graham and 15% Philip Fisher. Buffett took Graham's teachings even further. He added the dimension of quality to Graham's value-focused approach, but essentially he was writing with the same pen. Value, patience, logic. Buffett became one of the richest people in the world by using Graham's principles. But the source of this wealth was not being smarter, it was being more patient. Buffett once said, "The market transfers money from the impatient to the patient." Graham expressed the same idea in different words. Time is the investor's friend. That's why value investing is not just a strategy, but also a character test. Everyone wants to be rational, but very few can stick to it. Graham always told his students, "The stock market is a system that transfers money from the impatient to the disciplined. Discipline is the investor's real weapon, maintaining composure every day, despite prices, rumors, and headlines. This is never easy, because the market is a laboratory of human psychology. Fear, greed, herd mentality, they all play out on the same stage at the same time. And those who shout the loudest on that stage are usually the ones who earn the least." Graham was one of the rare individuals who could observe this theater from a distance. For him, the market was not a game, but a mirror of opportunities. Many people ask, "When should I buy?" But Graham's answer was always the same. "How long will you hold it?" Because it is time, not direction, that determines the outcome of an investment. A stock can crash in a day, but reach its true value in 10 years. Patience is the key that reveals this value. You cannot grow a flower by pulling it every day or watering it every day, but if you water it and leave it in the sun, it will bloom on its own when the time comes. Graham's investments are like that, slow, quiet, but inevitable. Today, we live in a world of artificial intelligence, algorithms, and millions of transactions per second. But here's the irony. What Graham wrote in 1934 still holds true, because technology has changed, but people haven't. We still fear. We still look at what others are doing and make our decisions accordingly. We are still looking for easy gains. Yet Graham taught us to pursue wisdom, not wealth. And perhaps today we need this more than ever. One of Graham's final lessons was this: the intelligent investor analyzes himself first. Therefore, the question we must ask ourselves before investing is, who am I? How patient am I? How much loss can I tolerate? Because the market is a mirror that shows us who we are. Making money is easy, but managing your own emotions, that's where the real investment lies. At the end of all these lessons, Graham summarized his lifelong experience in a single sentence. Investing is not about intelligence, it's about character. Even today, this sentence contains a deeper truth than all modern financial theories. Because technology, markets, and economies change, but human nature remains constant. And investing lies at the very heart of human nature. As Benjamin Graham grew older, he became more interested in people than in stocks, because he realized that the most complex thing in the financial world is not balance sheets, but the human mind. Graham always said, "The greatest success in investing is to be on the side of reason, not the crowd." But this is not easy, because the crowd is comforting. Even if you are wrong, there is a warmth in being wrong with everyone else. But the coldness of being right alone, this requires character. This was Graham's hardest lesson: mental independence. When a stock is fallen and everyone is selling, you must be able to buy. When something is rising and everyone is praising it, you must be able to doubt. This is much more than financial intelligence. It is psychological fortitude. The market is sometimes like the sea. It rises, it floods, it recedes, and most people move with the tide. But Graham said, it's easy to swim with the tide. The real skill is revealed when the tide goes out. Years later, Warren Buffett would make this phrase famous: when the tide goes out, you see who's been swimming naked. But the seeds of this idea were planted in Graham's mind. He understood that the market is not just a collection of price movements, but a collective expression of emotions. And in this performance, the smart investor is a spectator. He does not take the stage with the crowd. Times change, but the stories remain the same. The Nifty 50 stocks of the 1970s, the dot-com bubble of the 1990s, the crypto and tech craze of the 2020s. At the root of all of them lay the same sentiment. This time is different, but none of them were different. Human nature hasn't changed. And Graham was right. The greatest risk in investing is the investor himself. Graham's students, Buffett, Munger, Klarman, Templeton, all repeated this, because they all observed the same thing. Financial crises begin for human reasons before economic crises: greed, fear, overconfidence. One day, one of his students asked Graham, "Professor, what do you think wealth is?" He smiled and said, "Wealth is the ability to live without worry." This answer was a lifelong philosophy, because, according to Graham, the purpose of investing was not to accumulate wealth, but to gain freedom, to think independently, to live independently, to make independent decisions, to be able to live freely. Today, while millions of people talk about financial freedom, what they are actually looking for is this: time, thoughts, and choices of their own. However, Graham taught this not with a portfolio strategy, but with a mindset strategy. Those who want to win must first learn to be calm. For Graham, the stock market was not a game, but a school. People entered not to win, but to understand. Every decline was a lesson. Every wrong analysis was a teacher. Many people hid their losses in shame. Graham, however, wrote books about them, because according to him, knowledge could only be gained through the pain of experience. That's why security analysis is not just a book, but a laboratory. There is a mistake on every page, a lesson in every line. Over time, Graham realized that investing did not have to be complicated. In fact, most people were sinking by complicating their intelligence. That's why, in his later years, he always told his students, "Doing simple things correctly is better than doing complicated things incorrectly." According to him, the essence of investing could be reduced to 3 questions. Does this make sense? Is there a margin of safety to protect me? Can I be patient? If you can honestly answer yes to these 3 questions, everything else becomes secondary. Graham's famous quote on the first page still resonates: "An investment transaction is one in which thorough analysis promises the safety of principal and a satisfactory return. Anything else is speculation." This definition seems simple, but is profound, because the human mind likes to think it is investing. But most of the time what it is doing is merely hoping. When prices rise, we believe in intelligence. When prices fall, we believe in luck. But, according to Graham, the investor's job is not to be right, but to behave correctly. Graham's most famous book was The Intelligent Investor. But here, the word intelligent did not mean IQ. It meant emotional intelligence. The intelligent investor was someone who remained calm when the market fluctuated, did research when the crowd was fearful, and was skeptical when the crowd was euphoric. The intelligent investor makes market fluctuations his friend, not his enemy. That's why Graham's students always repeated the word composure, because logic only works in a calm mind. Today, millions of people around the world invest according to Graham's principles, even if they have never read his books. Index funds, long-term holding strategies, value-oriented investing, all of these stem from his ideas. The irony is that these ideas have now become standard. In other words, what Graham started as an alternative is now normal. But here's the difference. Today, people use the same method but not with the same mindset. Graham's goal was not, "How do I get rich?" It was, "How do I stay smart?" Graham was a rare figure in the financial world, someone who became rich and remained peaceful. Because in his eyes, wealth was not a goal, but a byproduct. If you think correctly, money will find you. If you chase money, you lose your mind. He saw money as a tool that opened the door to freedom, peace, and learning. Today, millions of people chase financial freedom, yet live in mental slavery. Graham saw this almost a century ago. That's why Security Analysis is not just a finance book, but a book of awareness. In his later years, Graham spoke less and observed more. Because he understood this, the market repeats everything, but people don't listen. In one of his last interviews, he said, "I no longer get involved in the noise of the market." Because trying to correct things they don't understand is like fighting the wind. This silence was wisdom, because sometimes the greatest insight comes from thinking in silence. When Benjamin Graham passed away in 1976, he left behind not a fortune, but a legacy of thought. Today, millions of investors still make decisions based on his ideas, but what he really left behind was a way of thinking. A century later, the same thing still holds true. Markets change. Technology changes. People remain the same. And Graham's voice still whispers, "Investing is not a test of intelligence, but of character." That test continues today. Millions of people who make decisions in front of screens every day struggle not only with prices, but also with their own inner worlds. And in this struggle, the winners are not those with the most knowledge, but those who are least shaken. Graham spent most of a century watching smart people do foolish things with money, but he watched with curiosity, not cynicism, because understanding why people succumb to their emotions was not about investing, it was about understanding life. Today, every investor looking at prices on the screen is taking the same test: reason or emotion, patience or fear, independent thought or the comfort of the crowd. That's why Graham's teachings never end, because human nature never ends. And perhaps, at the end of this whole story, the simplest but most powerful lesson is this: the value of an investment is equal to the character of the person who made it.